Recently, every single day, the US adds about $25 billion to the national debt. Now, that's just over $1 billion per hour, or $290,000 every single second. So that's 290,000, that's 290, that's 290, that's 290. You get the point, right? To put that into perspective, by the time you would have finished watching this video, if it's about 10 minutes long, the US would have borrowed another $173.6 million. In just 10 minutes, this amount could fund 3 SpaceX Falcon 9 rocket launches, buy around 420 average US homes, or erase student loan debt for roughly 4,400 Americans. Now, the US national debt isn't just a big number, it's being pumped at a rate which seriously can potentially impact your future, your livelihood, and the future of the US in general, right? So today, let's break down exactly who the US owes, why this matters to you, and what needs to be done to fix it. And we'll also touch on what you need to be doing right now in light of all of this. Alright, so how big really is this debt problem? As of October 2025, the US national debt now stands at $38 trillion. Just look at that thing go. Meanwhile, the interest paid on the national debt is more than the national defense budget. So the money just paid to service the debt is more than the money paid to defense. To put that into plain terms, imagine your household owing more than your income for an entire year and the interest costs getting so high that you're barely paying anything towards the actual debt. Now, that's basically what's happening on a federal level with the US government and this debt. All right, let's look at who the US actually owes, right? So the majority of the US national debt is about 75% held by domestic entities, including the US government itself, domestic investors, and the Federal Reserve. A smaller but significant portion, so 25%, is held by foreign government and international investors. Now, let's look at that 75% in more detail. 42% is domestic investors, so you can think of your mutual funds, your pension funds, your banks, etc. A further 20% is held by government entities and trust funds, with Social Security Administration being the largest investor at about $7.5 trillion. The Fed then holds about 13% on their balance sheet. If we look at the foreign investors for a second, Japan is the top holder at about $1.15 trillion, followed by the UK at $900 billion, and China at about $765 billion. So yes, the US government owes a lot to other countries, but nowhere near the amount it owes to themselves. And this can complicate things, right? Because there's pressure coming from both sides. There's pressure from foreign confidence, as well as just, and more importantly, domestic stability. All right, so why does any of this matter? All right, so we understand the severity of the problem. However, let's look at how this and why this matters to the US government, and then we'll look at how this matters to you personally. So let's take the government to start. Firstly, it's the rising interest payment. As the national debt increases, so does the interest the US government then needs to pay, and this diverts billions away from essential services like education, infrastructure, national defense, and the ability to feed back into the community and feed back into the nation itself is then seriously impacted due to the amount that it just needs to spend on servicing debt. All right, secondly, it's slower economic growth risk. So if the debt then continues to outpace the economic growth, the country then faces a triple threat of higher inflation, higher interest rates, and longer term stagnation. This then leads on to next, investor confidence risk. And if markets then begin to doubt the US government's ability to manage its debt, then borrowing costs will rise. And this is where things go south really fast, making it even more expensive to issue new debt. And lastly, following on from all of that is default risk. And this is worst case scenario, a US debt default. This will cause global markets to spiral, job disruptions, pensions at risk, and it would change the economy, the global economy, in a way that's never seen before. All right, so how does any of this impact you personally? Well, firstly, more expensive loans, right? So with rising national debt, that then means rising interest rates. And this directly impacts your mortgage, your car loans, credit card rates. So anything linked to an interest rate is impacted with the national debt rises, and the interest rate then rises as well. All right, the second way this impacts you personally is through more expensive goods driven by a higher inflation. And there are three key things driving this. So the first is more debt, then leading to more borrowing, which would then lead to more money in the economy. And if supply doesn't keep up, then prices will rise. Next would be investor confidence dropping, and that will lead to a weaker dollar. If investors stop buying US Treasury bonds, then the demand for the US dollar then drops. A weaker dollar then impacts import costs, as anything that's imported will now need to be done with a weaker dollar. Any food, electronics, fuel, this then all pushes up the prices because the dollar is weaker. Now, lastly, a default from the US. This would be unprecedented again. The global economy will shift. The world as we know it will shift. And this has serious implications for your future, your pensions, for your job, and just global markets and the global economy as a whole. All right, so let's talk about what the government is doing now to address the deficit and the debt. Now, this is currently a point of contention. Some people think that enough is being done. And of course, there are people who think on the current circumstances, and understandably, that more needs to be done as soon as possible. So the first thing that the current administration has done is they have provided some short-term relief. In July earlier this year, the debt ceiling was raised by $5 trillion, bringing the total debt cap to $41.1 trillion. Now, this sounds very counterintuitive. Why would we borrow more when there's a debt problem? But this avoids an immediate default crisis and keeps the government functioning. Now, secondly, it's increasing revenue through trade. And this is through the new administration's tariffs implemented. Now, fiscal tariffs have now skyrocketed to $195 billion, up from $77 billion the previous year. Next is spending cuts, and the education sector has taken the brunt of this, which expectedly has been quite controversial. Now, things seem to be trending in the right direction, however, as the deficit has shrunk by $41 billion for the first time since 2022, though it still stands at a whopping $1.78 trillion. So there's a long way to go here. So the last way the US government will look to address this debt and deficit problem is through growth. Now, many economists are of the consensus that the debt is way too large to completely grow out of. However, growth does help. It creates jobs and improves wages. It also improves investor confidence, which leads to a stronger dollar. So it keeps the dollar high, which means import costs can remain low and keeps the economy growing. Now, growth is a key focal point for this current administration of the US government. We've seen some massive deal announcements over the last few months. We've got Apple, deal announcement by Apple, so $600 billion investment into US manufacturing. We've got Project Stargate, which was a big one, led by SoftBank in partnership with OpenAI and Oracle. So that was $500 billion announced. Nvidia of about $500 billion. All of these are done with the intention of spurring growth in the US economy, looking to reshore jobs with the aim of more tax revenue to the government. All right, so we looked at what the problem is, what's causing it, and how the government is looking to fix it. But what should you be doing to protect yourself? So let's start firstly with your debt. Look to aggressively pay off any high interest rate debt. So any credit cards, any personal loans. Again, having high interest debt already, should be a no-no. You should look to pay off that aggressively. But entering an era where interest rates can potentially rise, that will then directly impact all of the outstanding debt that you do have. And so look to pay these off very, very aggressively. And now next is, it's a given, it's a rainy day fund, but it becomes even more and more important entering an era where potentially interest rates can rise and this debt problem can spiral out of control. High interest rate environment leads to a more difficult environment for businesses, hence a slower job market. So it's always best to have that extra cash just to cover you in any unforeseen circumstances. All right, so the next thing is diversification, right? Now, I'm a strong believer in dollar cost averaging across broad-based index funds like the S&P 500. That said, however, in an environment like this, it's also wise to add assets that hedge against inflation and hedge against a weakening US dollar. And the number one asset for that, in my opinion, is gold. So I would suggest you do look to add some gold to your portfolio. And this basically helps in the event that US equities take a hit during a debt crisis. All right, lastly is to do your best to just keep informed, right? So informed, not fearful. Panic leads to poor decision making. I'm not suggesting off of any of this that you sell your home or you cash out of any of your investments, but it's important to stay aware of the potential risks and allow yourself to prepare accordingly. And just more importantly, understand how this impacts you personally and not just how it impacts the government or impacts the market. How does this impact you? And prepare for that. My final thoughts on all of this is, yes, the debt is enormous. And yes, it's growing very, very fast. But the US economy is enormous as well. It's innovative, it's resilient, and it's global. But urgent action is needed from the US government to address this. Very urgent action. And the hope is that real solutions are implemented and not just delayed and pushed further down the road. If you learned anything today, if you learned something, please feel free to drop a like, subscribe, and drop a comment and let me know your thoughts about the future of the US economy and the current debt problem. All right, that's it for me for now. Peace.